The Placing You First podcast begins in less than 20 seconds.
Visit crcgroup.com to subscribe, download our award-winning tools and intel articles that help you stay aware of emerging issues and trends, or get a snapshot of the insurance marketplace with our industry-leading Ready indexes. You'll find it all on crcgroup.com under Tools and Intel.
Welcome back to Placing You First, where we talk about what's happening in the insurance marketplace and how it impacts real people and real businesses.
Yeah, and today we're focusing on senior living and long-term care. It's an industry that's growing fast, but it's facing real operational, regulatory, and insurance challenges.
We're joined today by Donna Hurley from Future Care RRG and CRC Specialty Brokers, Rusty Hughes, Lee McClure, and Truett Taylor.
This is the Placing You First podcast from CRC Group.
This podcast features news and insights from a vast knowledge base of more than 5,500 associates who write more than $30 billion in premium annually.
Plus, we give you the latest information on what's happening at CRC.
This is the Placing You First podcast.
And now the hosts of the podcast, Amanda Knight and Scott Gordon.
Thanks for being here, everyone.
Thanks for having us.
Well, to kick us off, I think I'll just throw us into the deep end of the pool. Everybody knows that the senior population is growing, but what is the real world impact that you all are seeing? You work in this business day in and day out. So what kind of impact are you seeing inside senior living and long-term care facilities?
Thanks, Amanda. I do believe, I think we all know, our population is aging very quickly, and we're developing chronic healthcare needs at a much earlier stage in our life, and we're living longer, which makes this a very emerging industry. I think the numbers we're showing, the senior living market is estimated currently at about $118 billion in 2025 and is expected to rise to about $213 billion by 2035. So definitely emerging market. That being said, we're seeing some huge swings between higher acuity of resident care needs and the assisted living space, which are definitely calling out a need for higher training levels and our staffing, higher pricing metrics, and really kind of struggling with a workforce in healthcare that's already taking a look at some severe shortages. And that's really putting a lot of pressure on facility staff, right, to be able to assess resident care needs to ensure care needs are being met. Because in the long run, the success comes in the fact of occupancy, right? As long as our facilities are full, we're able to be in the business of providing care. But that does open the door to increased exposure, which I'm sure, Truett, you could definitely hit on that.
Yeah, absolutely. We're seeing it every day. The assisted living claims that are coming through seem to be tied to more higher acuity residents that may or may not should or could potentially be in a nursing home setting. Obviously, the assisted livings have pressure to retain those residents, to keep their beds full. The families themselves, a lot of times, do not want their family members moved to a skilled nursing type facility. And so there's a lot of pressure to keep what would be higher acuity residents in the assisted living setting, which a lot of times, as you mentioned, Donna, the caregivers may or may not be skilled, trained, and ready to take care of that, provide that level of care. So it's an ongoing issue that we're seeing on a daily basis.
Are we seeing other issues, guys?
I think honestly, one area that is definitely an emerging conversation for most families is how to pay for long-term care. Right? We've got the fact that our dollar isn't going as far as it used to. We're definitely impacted by inflation, and I think we take a look at different interpretations of inflation. But wages is truly the bulk core of the care that's being provided. So funding resources for families, private pay care is becoming more and more difficult to achieve. And that being said, taking a look at different funding experts in the public space, different Medicaid share programs, I think we're seeing a lot of emerging Medicare Advantage plans that are opening access to individuals for care. So it's a really good thing from a market trend, because one major concern for operators was how to sustain in a private pay market for assisted living. So it's nice to see that we're taking a look that the government that may be is evaluating those needs and ensuring that care needs can be met going forward.
One thing I would say that ties all this together from an insurance perspective is if you'd asked any underwriter 10 years ago, they were still able to make a clear distinction between a skilled resident, a memory care resident, a true assisted living resident, and and an independent living resident. There were clear underwriting guidelines for all of those different classes, but now the guidelines have gotten clouded because of what Truett touched on in terms of assisted living, trying to keep residents longer than maybe they should. And so what that's done from an insurance and market perspective is it has caused costs for all those sectors to go up, where skilled used to be the highest. Now there's no real clear distinction between, say, a skilled nursing bed, a memory care bed, and an assisted living bed. They're all being broad brushed together most of the time. So that's where a lot of this has impacted the insurance side of things.
Well, yeah, we touched on a lot of this, but in terms of like trends, what are some of the biggest macro trends you guys are seeing that are that's shaping this space right now, especially from like a risk and insurance standpoint?
I'll start on that. I think, trends that have continued from the previous years is Donna kind of touched on it earlier, but you've got labor shortages remain very persistent. Definitely in the skilled nursing, levels of care. They're competing with hospitals for wages and benefits. Donna had mentioned, private pay and insurance and reimbursement. Reimbursement rates continue to be, they continue to strain margins on these facilities. You've got other inflation issues. Medical costs are driving higher claim severity, settlement values. We had touched on nuclear verdicts. Those have not gone away. Those have actually are going to continue to go up until, certain states and really all states decide to have some form of tort reform. That's really, that's going to continue in trend.
I think I'm going to piggyback off of, what Lee just mentioned in regards to, we used to call them nuclear verdicts. Now we're like going into thermonuclear land is what I've been hearing a lot lately. I think, it keeps going. But I think one thing that was it was very disturbing to read in this month is we now have our highest ever verdict in a long-term care case in Florida. It was $200 million. A 97-year-old resident, was able to access a stairwell while she was in her wheelchair. Unfortunately had a traumatic fall resulting in severe injury. But, that is really what is driving this industry. To Lee's point, I think we all can agree in the long-term care space, things happen. They do. We're providing care for grown adults in a very pro-resident right era. We take a look back. I said the pendulum swings so far in each direction. It really does over the years. But, I can recall being a high school kid doing my volunteer time in a convalescent care home back when we were syringe feeding people and they were being restrained, to their bed and to their wheelchair, to keep them alive and keep them safe. But that was, in some eyes looked at as, a terrible way to exist. So we shifted and many states adopted resident rights, for good reason. But now we are in an environment where some of the safety measures that used to be utilized are no longer access points. So these claims are happening. They're more severe. I think on national trend right now, a fall with fracture is the largest emerging claim that we're seeing in the long-term care space with an average indemnity payment of $250,000. For a facing fact, if you take a look in some, and not we ever want to compare, but if you take a look in some other civil markets, the long-term care verdicts are becoming larger and larger by the day, which is a call to action for tort reform. We've got some states like California where we have some severe challenges and trends without having lower limits in that capacity. So I think some of these things are definitely going to need some partnership and adopting caps to kind of make the long-term care industry continue to succeed and continue to meet the needs of the growing population.
Yeah, I would comment on another trend. This is more for the underwriting perspective of these senior care properties, but ownership structure can definitely influence underwriting outcomes. As we mentioned before, private equity-backed facilities are going to face heightened scrutiny unless they can clearly demonstrate, strong governance, consistent staffing, and a patient-first kind of model / mentality.
The M&A and the private equity stuff is real on the insurance side of things, because the marketplace is generally can be a little skeptical because they're really trying to anticipate, how long are we going to be on this risk? How much are they really going to invest in the care for these residents? What are they going to do truly to improve this facility? Are they going to, what's the bandwidth that they have to really stay on a portfolio of different locations, and so that affects the underwriting side for sure, and that's very real, and that drives pricing.
And to piggyback on that, a lot of the times the acquisitions that are happening for a reason. There's a lot of times the reason these facilities are for sale is because the prior owner is either underwater financially or struggling to operationally meet the needs of the facility, so much so that they have decided to just let it go or get out of the business. And so those, a lot of times what we see are those types of facilities that are the ones being acquired, which then complicates the underwriting process because they're going to want to know plans for improvement and who the new owners are and what experience they have and everything that Rusty just mentioned. So it's kind of a double-edged sword of new owners are coming in, but a lot of times they're also picking up underperforming facilities. And so it makes it, twice as difficult to place their coverage.
Well, and I know Rusty kind of mentioned this a few minutes ago about how it's easy to paint everybody with the same broad brush. And it sounds like some of these macroeconomic trends also add some other layers of complexity. So what is the marketplace for insurance like right now? I mean, is it capacity available? Is it uneven? Where's the capacity coming from? Talk to us a little bit about what you all are seeing as brokers in the marketplace.
I would say, most senior living placements continue to reside in the E&S market. Obviously, that's going to allow the most potential flexibility and tailored solutions for those buyers. But it's very inconsistent. We're seeing, generally, primary, limits from 1 to 4 million, with excess capacity being anywhere from 5 to 15, but most excess carriers are reducing capacity to 5. Also, we feel like, more than ever, underwriters are forcing more risk management onto the buyers. So if an insured can, show that they're actively executing risk management plans, not just saying, hey, thank you, but actually implementing what's been suggested, that's actually going a long way in renewal outcomes.
From my perspective, there are really two distinct markets in senior living. We have the primary world and we have the excess world, obviously, and we touched on that a little bit. But the reason why you kind of got to think about them in two different ways is because it used to be that you could go get a primary deal done in this market and then go to anybody and get a $5 or $10 million umbrella to sit over it. Well, now those times have changed because Donna spoke to it earlier. These nuclear verdicts that are happening all over the country, these carriers want to be able to control. These carriers want to be able to control all aspects of a claim, and so there is hesitancy for a lot of these major carriers, a lot of the ones that we do business with, to sit in an unsupported excess position. That continues to be a problem.
Yeah, and I was going to add, obviously, this is the claims are a long tail process. You don't just settle a senior living claim overnight. It takes 2, 3, 4, maybe even as much as 5 or 6 years to reach the ultimate settlement. And a lot of the capacity in the marketplace is newer, like within the last 5 years. And so while there is a lot of capacity currently, I would say a good chunk of it is newer capacity that doesn't have the full depth and history of claims reaching settlement to really determine how profitable they may be on their book of business, and that's going to continue to be a challenge for a lot of the carriers in the space, is competing against those who don't have full loss history data to look back on and determine their pricing models.
Would you guys say, just for perspective, that pricing obviously drives a lot in the marketplace? I think we take a look at operators. I mean, my forte initially was in that realm, is that at times, we're shopping for the cheapest policy out there and we don't necessarily know what we're buying. What are you guys seeing out there with regards to just overall demand on the pricing level?
I would say most everyone, the expectations are projected to be flat up to 15%. I think it's all going to be driven, number one, on the level of care, number two, develop losses, and three, the venue. And I think, like Rusty and Truett had mentioned, the new capacity is in let's buy business mode, whereas some of the legacy markets that have been in this space for 25 years are trying to pad for the future. So they're trying to get inflationary, rate increases between 5 and 7% to kind of, make sure they're in this space for the long term.
So, for retail agents who are listening to the podcast, what are the biggest coverage pitfalls that you guys are seeing when senior living accounts are marketed incorrectly?
So the biggest one that I'm seeing on a fairly regular basis is the extension of abuse coverage and how that works throughout the umbrella. As Rusty mentioned earlier, the availability for unsupported excess is becoming less and less. And as you need more and more carriers, coordinating that particular coverage specifically has become a challenge. And so if I see one thing where there's coverage pitfalls, it's typically that the abuse coverage, which is a significant exposure in the senior living space, is not properly carried forward through the entire umbrella tower.
I would, that's a great one, Truett. I would also say, in addition to abuse, we're seeing constraints put on the actual abuse limit in the primary. We're seeing carriers sublimit abuse, which makes it again difficult. We're seeing some carriers sublimit adverse events. So your cause of loss, your falls, your elopements, your pressure ulcers are being sublimited. You're having class action exclusions, which can be a big hurdle, and then paying attention to the trigger. If it's a claims made form, what triggers an event, whether it's incident sensitive or written demand.
Absolutely. Well, we talked about all the fractures and falls and everything else that comes in this business. So claims and litigation seem to be a constant concern in this space. What types of losses are driving the most anxiety right now, and why?
I can say without reservation, the number one claim still is falls, resident falls. There's no question about it. And then close behind that is obviously elopement and bed sores. I mean, those are still the top three and have been for quite some time. But falls, far and away, still the leading cause of claims in senior living facilities for sure.
What I would add is that I've seen quite a bit here recently is after COVID, prices went up significantly. And so typically when prices go up, one of the ways to get it back down is to take on a higher deductible or retention. And so in 2021 and 2022, a lot of our buyers took much larger deductibles, sometimes as high as six figures and more, to take their premium costs down, which sounded like a great idea at the time. But as I mentioned earlier, these are kind of long tail claims. And so those claims that were filed when they had that larger retention in 2021 and 2022 are now coming due and being settled. And we're finding that a lot of these operators and insureds are having a hard time cash flowing that financial responsibility. And in turn, the insurance companies are having a hard time and finding themselves in a credit risk where their insureds are not able to pay those deductibles or retentions.
Yeah, I would say I know I kind of caught a little bit on there. I know I touched on falls with fractures being an emerging trend. I heard elopement. Yes, we wish it was running off to Vegas. That would be a great time on doing so. Med-airs always do play a role, but I think one of the largest issues currently is documentation. I think that we are in an environment where documentation is subjective. Most of the time in any healthcare space, we chart by exception. That, when we care plan for something to happen, it's not going to get charted, it's being done. The legal interpretation of that is much different. They like to poke holes in that. And I call it sometimes that $500,000 conversation because in the eyes of the legal world, if it isn't charted, it didn't happen, right? So it's how do we find a way in our facilities to train, and I call it motivate, right? Educating our staff that charting, while it is laborious and it can be, the equivalent of a whole extra person, that's how we celebrate the work that we've done. So, those are definitely some of the issues in there. I would go on admission and retention. I know we touched on it in a few topics ago, but, the long-term care lifespan is a huge ecosystem. There's a lot of different intermediaries. You've got skilled nursing elements where skilled nursing beds are very hard to find now, long-term skilled beds. So it leaves the assisted living marketplace open where folks are a non-clinical setting. They're admitting residents. They may not be able to meet their needs. And a lot of times we run into that being a whole other layer of issues on claims dynamics. So, I mean, obviously it's an emerging trend. It seems like there's a new thing every day that's popping up pertaining to venue and different elements, but those are the top breadwinners at this moment in time.
Donna, I know that this group has been working with Future Care RRG for quite a while now. And so we brought you on today because you clearly are absolutely plugged in, to this space and are a great partner with and for us. So can you tell us a little bit about what you do at Future Care RRG and what kind of risk management strategies can really make a difference for these insureds?
Well, thank you for that. It's been a great partnership. I definitely appreciate it. I think in general, we can all kind of globally view the fact that, most of the time with our operators, they don't want to talk to their insurance company. They generally aren't excited to do so until even then when a claim comes in the door. I know at Future Care, we really have tried to foster an environment where we want to be a partner, right? We call our insured members for a reason, is that we are a group of like-minded individuals that sink or swim together. So that kind of ties into my role as being the director of risk management that we have adopted and definitely understand that one size fits all does not fit the long-term care space. That we are very much just like in our underwriting style, we're looking to create a person-centered approach for our members to help support them. I think we can really, truly all agree our member base is very dynamic. We've got, when I say smaller, everything is mighty, but we've got some operators that have smaller bed counts. We have some larger operators. I can say from my background in a larger space, what works in Tallahassee doesn't work in, down the street in Miami when we're under the same ownership with the same policies. So our goal at Future Care is to work with our members and find out their specific root needs of where we can assist them, where we can help motivate them, where we can fill some holes that may be needed. And sometimes that even works. We've really carved out a great program in this last year where we now have some amazing vendor partners out in this space that have provided additional tech solutions to some of our members where they may have, some short gaps in staffing to be able to help support their fall mitigation planning. To be able to work with national pharmacies to go in and do training directly from pharmacist groups with our facilities on how to reduce med errors. So I think it's been a really great experience. And I think that kind of all ties in. I think in insurance, we all look at everything as being a risk. So we are partnering that from our underwriting standpoint all the way through to our claims. Because while I want everybody to be proactive and take advantages of the services we have, sometimes we don't get to talk to our members till they submit a claim, right? And while we want to work on claims handling, we also want to take that opportunity to reduce the likelihood of repeating that incident in the facility. So we work closely with our members on that process as well. And I think another great thing is, continuing to assess what we're bringing to our members on a continual basis. That it's not, once we've created the program, we need to really take a step back and listen to our amazing partners and our members of where they would like to see more from us in the long run as well.
Well, and I know that we're a little biased around here, but I know that this team, that our healthcare team in general, across the board, we may not be able to tell you what you want to hear every time, but you'll tell the truth, right? We can't always tell you the thing that's going to make you the most happy, but we'll tell you the thing that's honest and true. So that goes a long way, I think, with clients, with agents, and with insureds. So beyond that, what can you guys tell our listeners about the things that make CRC Healthcare the go-to partner for these kinds of risks? What do we do really well that makes us true specialists in this space?
So I think to start, you hit the nail on the head, is that we are specialists, and and our first and foremost goal is to take care of the client. And if that's telling them, good news or bad news, we're going to deliver it, and we're going to make sure that they become specialists in the arena, and we pass as much knowledge as we can to them. And I would say the other thing that we do exceptionally well is what we're doing today, is working together and sharing information amongst ourselves and with others that makes us as a whole better. I think we do that better than anybody else in the marketplace. Without hesitation, I can say that. And so I think that's, when you work with one of us, you get all of us. And that's that's a pretty big statement. So
True. And I think that's well said. I think, if you look at our office in Birmingham, we have tremendous stability. I mean, I think if you were to, add it all up, we have over 100 years of insurance experience. And most importantly, that's tailored toward the senior care industry. So we feel like, we're incredibly positioned to have our, finger on the pulse to understand trends, what's going on. And like you said, Truett, be honest and transparent. Every deal is not a deal we're going to write, but we're going to kind of give you an assessment of the marketplace. Are they insured properly? And hopeful, we can, at least make the client in a good spot. So that's something to be really proud of.
I might just add from, a partner perspective, I think you guys have done an absolute amazing job on advocating and listening. That's one avenue that I don't think is, it's very unique to the CRC team in that capacity. And that you are always looking out for the best interest of your insured and your partnership. So we definitely thank you guys for that.
Well, you guys have made it through the hard part. Now we're on to everyone's favorite part of the show, rapid fire, where we ask just a couple of questions, quick answers. You don't have to think too hard, just whatever comes to your mind first. Question number 1. What's one hobby or interest that people outside of work might be surprised to learn about you?
I'm an old school hip hop fan.
I would not have pegged you for that, Rusty. Old school hip hop would not have gone there. I love it.
I'm a obscenely unhealthy Boston Red Sox fan, so it becomes an affliction that can really impact my life depending upon which way. So
people down here feel that way about SEC football, so we understand.
Yes.
That's right.
Anybody else? Lee, Truett?
I'll say it. Okay, I'm addicted to contrast therapy. I love a good sauna and a cold plunge.
Really?
No doubt.
Huh. I did not. I see it all over
I've never heard of that until today.
I see it. I didn't know it had a fancy name, if I'm being honest.
Yeah,
I see
right.
people do these things on social media, but I didn't know it had a name. So I've learned something, Lee. Thank you.
I'm an insurance golfer. Which basically means that I play golf when the job allows, and I'm absolutely terrible. But I'm absolutely terrible both right-handed and left-handed. So I like to go to the golf shop and ask for a right-handed club, and then ask them for a left-handed club, and let them look at me and tease the pros.
Right?
We've witnessed it. It is something.
Just
to
see what their
behold.
faces do.
It's not like baseball. Yeah. On to question number 2, which is what life hack is saving you right now? In other words, this can be anything that makes your life easier, from grocery delivery to an app, a tool, a habit, something you've changed.
Anything. Sky's the limit.
I mean, for me, it's DoorDash.
Yes. No cooking required.
Bingo. Yep.
You did.
Although I had to take the app off my phone for this. It's my 2026 goal because I saw how much I spent last year. And so the life hack is now removing it so I can put some money away.
There you go. Yes.
Well, it has been a delight. Thank you all for joining us and for being such good sports here at the end. The senior living realm is clearly a sector filled with both purpose and pressure.
Growth is guaranteed, but stability isn't. And navigating that gap, we know it takes expertise, partnership, and thoughtful risk management. So make sure you reach out to your CRC specialty producer for assistance with your senior living account placements.
We are not reading this off of cards. Thank you all so much for coming. Donna, Rusty, Lee, Truett, thank you so much.
Thank you, guys.
Thanks, guys. Enjoyed it.
Thank y'all.
That was a lot of fun.
Thanks to all of you for listening to Placing You First. Don't forget to subscribe and share, and we'll see you next time.
Are you ready to move faster and go further? Take your career to the next level. Join Team CRC to gain access to best-in-class tools, data, exclusive programs, and more. Send your resume to resumes@crcgroup.com and read testimonials from recent hires on LinkedIn.
Search for CRC Group.